Our central banker is fighting the wrong fight. Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is a face that will be familiar to many of you, Ed Harrison, senior editor at Bloomberg, and one of the original hosts of the Daily Briefing. Hi, Ed.
Hey, Maggie. Good to talk to you.
Yeah, welcome back. It's so good to have you, and certainly this is our first time doing it, so I'm super excited. And we're going to talk a little bit about those early RV days. It is our 3-year anniversary, everyone. Drum roll. But we have a lot of developments and a lot of news we got to get to first. So let's do that because, just in the last half hour, sort of widespread confirmation of what everyone's been trading off of all day. A group of large U.S. banks, Goldman, Morgan, Wells Fargo, Citi, J.P. Morgan, Morgan Stanley, J.P. Morgan, just to name a few. There's even more than that have come in with a backstop for First Republic combined. They're going to contribute deposit $30 billion into the bank as a backstop. Ed, it's really interesting to see this coming from the banking sector itself. Very different situation with what we saw with SVB. Well, what do you make of this?
Yeah, I mean, it's hard to say. I think that it's done a good job in stanching the bleed because my basic view is that we're not in a systemic crisis as yet. It could develop into if you think about Silicon Valley Bank is sort of a Bear Stearns type of bank. It could develop into something. So this is a trial to get us away from that. Because up until this point, the U.S. economy has been relatively rate insensitive. We've gone through almost 5 percentage points of hikes from the Fed, and so many people who have mortgages are locked in at really low rates. So many corporations are locked in at really low rates. They don't need more borrowing. So I think that there's a lot of rate insensitivity relative to other cycles. And that was starting to unravel with what we saw here. And I think there is going to be a sea change now in terms of regional banks, small banks, but you're not going to see the level of distress you would otherwise because now we're starting to see things come together through bailouts, of course.
Yeah. Yeah. And I think that you bring up a good point, and we were talking about this all week. There's a psychological component to this, right? And so now you see the big fellas moving in with speed to try to calm the situation, right? To try to sort of, prevent that deposit run, basically, that everyone had been worried about. But do you have a sense that we're at the end here, or has it just sort of injected some calm into the situation?
It's injected some calm into the situation because when you think about it, I think it's interesting. You were talking about the deposit runs. It's actually those guys who are benefiting from the depositing run. So the fact that they're the ones who are doing the bailout suggests that what they're saying is, this is a crisis of confidence. First and foremost, we need to, get that sorted out. Us, the people who are getting the benefit, assisting this bank, which is the next in online, will hopefully get rid of the crisis of confidence. Then we can get down to the sticky wicket of, where the body's buried in terms of credit problems. Because my personal view is it's commercial real estate. That's a slow bleed that's going to happen, but that's not an acute problem right now.
Yeah, and that's really important, and I want to dig into that a little bit. So it's interesting, and you can imagine we're probably going to find out later on some of the very interesting conversations, and I think this is the long shadow of the great financial crisis. You saw the private sector come in, not the government, because the sort of backlash against bailouts was evident right from the start with the SVB and the conversation around that. And you see them using uninsured deposits because there's still a lot of lack of clarity around exactly who is insured these days. Some people think the Fed's announcement means everyone is. Other people say, no, that's not clear. So clearly they're trying to front run some of the sort of public perception of this as well, so that they're not getting hauled in front of Congress again, I'd imagine. When we look at the banking sector, the regional banking sector, though, now, okay, so if we calm the psychology around it, we don't have people panicked and moving their deposits and trying to put them in the J.P. Morgans of the world. What happens? How are the banks behaving around credit availability now? What kind of impact do you think this is going to have on the wider economy?
Yeah, so I think that it's going to have a negative impact the question is how negative. The first thing to note is that, just like wholesale funding was a big problem with the likes of Northern Rock, and that's why they went to the wall, and also the whole model of investment banks, they got a lot of wholesale funding, and that was a problem in 2008. Today, we see with SVB having, uninsured deposits, that's a version of wholesale funding is negative. So First Republic, that's the exact same sort of thing. So the banks that have the most wholesale funding, that is unsecured deposits, those are the ones that were on the brink, because you could have people withdraw $50-100 million at a shot, and then suddenly you have to come up with the funds to deal with that. These other regional and small banks don't have that problem as much, because they have a much larger deposit base spread across their retail banking network. Their problem, however, is what's on their balance sheet, and this is obviously where CRE comes into play. So what they're going to do is say, first and foremost, we already saw what happened with SVB, and also we know that what's coming down the pike. Now's the time to husband capital, to make sure that our credit decisions are very robust. And so I think that we've crossed the Rubicon into what I would consider a credit crunch of sorts. They're going to make sure that they're not, no one can point the fingers at them for having loose credit standards, because they really want to make sure that they have the capital necessary.
So that'll help them, but what does that do to the wider economy? We know from the financial crisis, credit is the lifeblood, right?
Right, exactly. Yeah. So I mean, that is the question. So I talked about the rate, the rate insensitivity. So many people are locked in to great rates. So to a certain degree, you could say there is some credit insensitivity. But so at the margin, this is it's a disinflationary trend. The question is how disinflationary? We really don't know. I think right before we got on, Maggie, you and I, we were talking about no one knows anything. Throw out the old models. The pandemic basically screwed everything up. I mean, the reason that we're talking here now is because 3 years ago we started this program because of the pandemic. If it weren't for the pandemic, you and I wouldn't be talking to each other.
That's
So
right.
everything's totally different.
It is. And we've heard that consistently from really experienced people too. We're not, these are not people who are new to these are people who've been through crisis. They've been through crashes. They've traded it. They've thrived in it in many cases. So it's not that there's not opportunity, but it's just really hard to kind of tease out, especially when it comes to the time lags. And I think you brought up a really important point, and I think a lot of our viewers know it, but just in case, this is sort of unique to the U.S. that you can lock in at these lowest, certainly with housing. I don't know if it's the case with commercial loans as well, but that you can lock in loans at this very low interest rate. Mortgages here are locked in for 30 years many times. I mean, that's a pretty big cushion if you're able to get that rate. So the lag of this, the time effect of the Fed interest rate hikes is hard to figure out in every area, isn't it?
Yeah, and I think that when you think back to 2008, that's one of the big differences, is that you remember all these people who had these arms, they were paying like interest only arms and stuff in order to get into these houses and to keep the payments as low as possible. When rates reset up, all of these people were suddenly having to pay more. That's the norm in most other economies, that you have a adjustable rate period. You have a fixed rate period, which is, let's say, 2 years, 5 years, 7 years. But then after that, it's going to be a variable rate. And that gives you more interest rate sensitivity in those economies. The United States, we're unique in the fact that we don't have that. So it's very difficult to understand, where the credit impulse is going to be. How far does the Fed have to go to induce the level of financial tightening that they need? Will it just go from 1 second, no distress, to like total financial distress? I mean, that's what SVB kind of points to, is that you go from no sensitivity to suddenly everything's falling apart.
Yeah, yeah, and I think that was what surprised people. G. Blackburn asking a question: if all banks mark to market are tier one risk-based capital ratios safe?
Yeah, I mean, so mark to market is a big thing. If you remember from 2007, 8, there were the tier three assets people were talking about in bank balance sheets. That is very hard to quantify assets, so they put it in tier three, so they wouldn't have to mark. Though they couldn't mark them to market, or they didn't want to mark them to market. But if they did, they'd have to mark down those books. So the question between solvency and liquidity, to a certain degree, revolves around those assets. What SVB was basically telling you is that they know for a fact that, and it's true, that if they were to hold these assets to maturity, they wouldn't have to mark them down. It's only if they had liquidity problems that they would have to mark them down, and that's what set off the whole daisy chain. And so this is where the Fed, in terms of their taking these assets for loans at par, comes into play in order to get rid of that risk. But when we're talking about assets, we're not talking about just risk-free government bonds. We're talking about other assets on their balance sheet. And those are the assets, I think, that they're not being marked to market. It's not a mark to market question. It's really a credit write-downs question. When those loans come due. Because, for instance, in commercial real estate, we're already seeing companies saying, we're going to hand you back the keys. That is that we already know that the occupancy rate for these properties are so low that it just doesn't make sense for us financially to pay the debt. So we're just going to default. This has already happened in Brookfield. It happened with the landlord of PIMCO. Blackstone did this recently with some Finnish real estate. Everywhere it's starting to percolate where these companies are just defaulting.
Yeah, and I think so this is where you see the biggest vulnerability. And is it systemic, this commercial? Because anecdotally, I think we all know, you drive around anywhere or walk through any major city, and all you see is for rent, for lease, for rent. I mean, anybody who is in any of these, even small office buildings, they're just ghost towns. I mean, there's no one in them. It seems like the scale of this could be huge.
I mean, that's what I think, and you have two problems there. I mean, the one problem is that it also decimates hotel real estate as well, because you have people not wanting to stay in those hotels for business purposes with those corporations. But then there's the very real inability to convert. At least you can convert a hotel, which is a residential-like accommodation, into some other form of accommodation for residential purposes, whether that be rental, condo, whatever it might be. But how are you going to convert an office building into another type of use facility? That's very difficult. And with the amount of stuff that you have, it's very difficult. I had a colleague at Bloomberg who was like, he said, I could run through, what's the name of Hudson Yards, stark naked in the middle of the day, and no one would see me. He was basically saying this is like a white elephant.
And that's a brand new.
Side.
It's been like that since they opened, from what I can tell. I mean, I don't get there often, but I have friends that reside, as you can imagine, in the CNN part of it, and it's been weirdly empty, I think, for the entire time. So I think this is really important, because this is the sort of where we go next, right? Which is what we like to focus on. How widespread are we talking about? REITs? Are we talking about who has these assets, these commercial real estate liabilities on their balance sheet? I mean, how can you get your head around how big this might be?
Yeah, I think that's the big question. My understanding, and I have a colleague who says that if you look at the Fed's accounts, 5 trillion of these assets are on bank books. But then, where are the other assets? Which banks have them, and which ones are compromised? So I think that this is a very large asset class, so it's systemic in nature. And the question is, from a financial stability perspective, who actually owns these assets? Who is the lender for those assets, and when are they going to be written down? and by how much? Because I don't think it's a systemic problem from an acute perspective. It's not like from one day to the next, suddenly everyone's going to go bust. But over time, as these rents, these leases renew, you're going to have more and more problems with the cash flows that these assets are going to be spending off. And so, a year, 2, 3 years down the line, that's going to be a problem. And the most important thing, however, is that in a recession, that problem is acute, because in a recession, that's when you'll see, a very, companies cutting the chain. They'll be like, that's it. We're gonna cut this lease and take the hard knocks. We see that in tech already.
Yeah.
If that fans out to the rest of the economy, then we're going to be in trouble.
And layer on top of that the fact that you have this fundamental change now in the way we work because of the pandemic. This is the unknown, right? If it were talking about a typical business cycle, then you have a real estate downturn. It's worse because you're in a recession, but now it's kind of everywhere, and it's a major shift in the way we operate.
Right. Yeah. And so, this is part of like how we don't know, these occupancy rates. There's occupancy rates. There's also over time, the percentage of people who are going to work will creep up to the level of the space that is available, that's being used. But right now, a whole lot of it's not being used, and even less of it is being occupied because people aren't going to work. So where do those things meet in the middle? Do they meet at 25% unused, unoccupied? Is that a sustainable level given the debt loads of these particular buildings might have? That's the question. But then also within the real estate segments, we're talking about generic office real estate. There are things like urban warehouses. There are things like data centers, things like life sciences that have good positive demographics that are also parts of commercial real estate that will be able to weather this kind of storm. But when we think about commercial real estate more holistically, we're thinking generic office space.
So you've been writing a lot about the savings and loan crisis, because this is and we've been talking about that as well. And one of the things that struck me is you pointed out that the knock-on effects, and one of the examples you were talking about is Penn Square, didn't show up at Continental Illinois for 2 years, right? Do you think we're going to see that kind of dragged out situation, or as you mentioned before with SVB, just information moves a lot faster now? Like, is the timeline sped up? We're going to get our hands around this and sort of be able to move on beyond it more quickly? Or could we be looking at a situation where everybody exhales and boom, we have another situation that flares up?
Well, yeah, I think that it's a combination of those things, because when you think about it, really, you can even go into crypto and think about some of the things that we've dealt with Silvergate. I think that's a perfect example. That was basically a delay of 3 or 4 months from SBF, right? So right there, someone's throwing a firecracker, a bomb into, and it's exploding, and we don't know that this person has internal injuries. That's essentially what's happening with things like SVB.
Well, we're the Walking Dead. You're telling us that there's a lot of Walking Dead out there. That's our
exactly.
Fear. That's our fear.
The SVB's problems only crystallized later because of the liquidity crisis. But there are tons of other banks out there walking around with this kind of stuff on their balance sheet. The Fed has made that problem largely go away because they said we're gonna lend at par, but there's other stuff in the balance sheet, the stuff that we're talking about. Will it be 2 years before it happens? It all depends, because if you think about the S&Ls in particular, think about how things happen. So it was the go-go years, 74 to 82. Right at the end of that, the Fed hiked rates aggressively so that you had two recessions back to back that torpedoed demand, and as a result of that, oil prices tanked. EM debt, there was the Latin American debt crisis perked up. That also was a contributor to Continental Illinois. So Then we get through recession, and so the recession's over in 1982. We're on the upswing there, and still these things are happening. And in the 1980s, CRE was one of the asset classes that the S&Ls were investing into to save themselves from the fact that interest rates had gone up and they were losing deposits. So we're at a different point in time right now relative to where we were there. Because these let's call the regional banks S&Ls, for this analogy, they're losing deposits now before the recession happens. So what happens, once the recession happens, especially because CRE is not going to be able to help them the way that it did in the 1980s. So you see that there's so many cross currents relative to what we saw there. It's hard to say how quickly any of this will occur. We can only talk to what are the vulnerabilities.
Yeah. That and that's what we have to focus on. I think you brought up such a great point. What we're dealing right now is liquidity, and Janet Yellen talked about this. She was talking about the stress test and it being liquidity problem versus a capital problem. But what you're talking about is assets on balance sheets that are going to have to really be looked at. That's a different wave of this that we really haven't reckoned with yet. We mentioned it's the 3-year anniversary. This show was certainly born at a time of crisis and uncertainty. Let's have a little peek back at that.
In lockdown due to the coronavirus. So we decided to talk to you through a brand new format, Real Vision's Daily Briefing. It's going to cover what's going on in the upside down world of global pandemics and financial turmoil. And to start off each show, we're going to provide you with a synopsis of what's happened in the day's markets and the latest news on the coronavirus front. And afterwards, we'll do a brief but deep dive into a theme that Real Vision has been covering, one that's relevant in the context of today's markets. It could be liquidity, the macro outlook, market structure, passive versus active, or Bitcoin, all sorts of things. But we hope you'll enjoy our daily briefing, and we look forward to hearing your feedback. So here goes for today.
That was in the very early days of the pandemic. Ed, I feel like I've aged 1,000 years. How have we gone through a pandemic and like every other crisis, and you look like you haven't aged for 1 second, 3 years?
That's
your
so funny
secret?
you'd say that. I was just before I came on, I was shaving all the gray hair away. I was like, like if they show that clip, I have to make sure that people aren't going to be like, oh my God, that guy looks like he's
oh my God, what has Bloomberg done to him? Well, you managed beautifully, but we really are. I mean, this was Real Vision was founded back in 2008 with the mission of democratizing finance. You guys launched the daily briefing in order to try to arm people with information, and now it feels like it's a polycrisis is a word I'm hearing a lot. Right? We've got war, inflation, this banking situation. We're getting a lot of different questions from viewers, which I want to get to in a moment. But when you look out at that sort of bigger picture macroeconomic landscape, what are you focused on? How do you feel about this debate about inflation?
Yeah, I think that inflation's a killer for purchasing power. So ordinary people, inflation's bad. For businesses, the ability to be able to predict where demand's going to come from and how it's going to go, it's also negative. The levels where it becomes negative, probably 4, 5, 6%. The levels where we are now, if that is a permanent state of mind, that's not a good place to be. I think the Fed is they won't tell you this, but they'll probably accept 3%, and maybe 3% is manageable. And in fact, I mean, we lived with that in the 1980s and 1990s with no problem, 2.5%, 3% on many occasions. So I think that they're willing to put up with that. But the levels that we have now, inflation, it's just bad for people, it's bad for businesses, and it leads to instability.
And it's so hard to figure out, to see into the future and get a handle on inflation in particular, I think, because of all these forces. Raul sat down with Imad Mastaq for a follow-up conversation. He is at the center of AI. The first conversation Raul called one of the most important. And that's what we love to have, talk about the macro, but have these people who are also involved in this cutting edge to try to figure out how it all sort of, hooks together, really. Let's play a clip from that, and then we'll talk on the other side.
If anything, when we talked last year at the iPhone original, you remember, it didn't have copy and paste. We just got copy and paste. Where's the App Store? The App Store is coming, right? And it's coming now because everyone wants to build the apps, and it's easy to build the apps. 4 of the top 10 apps on the App Store in December were based on Stable Diffusion, and that was the entire backend, a 2 gigabyte file. We got Neural Engine access on the 1st of December, the first AI ever, because these files, again, are entire backends that you can just build on in seconds, minutes. You can even get it to write the code for you. So again, like, I don't know where we're in 5 years, honestly. I just know that, again, this feels like the start of the pandemic, where there's going to be productivity booms, and on the other side, and I just see it as massively deflationary. I can't see how it's not.
The interview is mind-blowing. It needs more than one viewing. You can see the entire conversation on our website. Just hit the QR code for a free trial so you can see what we're talking about. Ed, it's really interesting. Imad is very clear that he thinks AI is massively deflationary, and he drops some amazing statistics to back that up, that the speed with which this is developing. I mean, everybody who's played with Chat GPT knows. Should the central banks be so focused on inflation given what's happening in technology? Do they even have their head wrapped around that to try to figure that into the inflation forecast?
It's a good question because you're looking at 2 different time scales. One is the inflationary time scale, which is like this very small period of time, and the other are these tectonic shifts that are disinflationary and deflationary over time. And we were already living in that world before. And the pandemic sort of shifted us out of that world, but for a very short period of time, I think at some point in time, the much more disinflationary forces that bring down prices, that increase price discovery, they're going to come back to the fore. And then, of course, you have the demographics and all of that kind of stuff coming together to force prices down. But, once the daisy chain of, supply chains, inflation expectations, and all of that come into play, it's sort of like a whack-a-mole for businesses and people to figure out, how do they change their spending habits and their production habits in order to deal with their price pressures, their pain points, and to make sure that they have enough money and profit to navigate the environment. And so that causes this whole sort of chain of events, and eventually that's going to burn itself out. But I think we're still going to be in that for a little bit.
Yeah. That timeline is going to be very interesting because so many people really think we're in a structurally higher inflation environment. And I encourage you, we may be, but if you think that is the case, you should listen to that interview and then see whether your mind has changed at all. It's going to be, I think we're all going to be going back to the drawing board and finding new models to look at this stuff. So Ed, we have a lot of questions about Europe, about Credit Suisse. A question, which banks in Europe are most at risk? Another question, will the Swiss National Bank sell big tech to fund a bank bailout? So what's your feeling about vulnerabilities in Europe?
Yeah, so I think that, Credit Suisse is kind of like JP Morgan or Bank of America, i.e. too big to fail. So on some level, what you could say, especially after Lehman Brothers, is there's almost no risk that they will fail. They will solve the problem one way or another. It's not going to fail. It will never happen. Lehman Brothers told us that they tried it, and Lehman, by the way, wasn't like a systemic institution at that time. It wasn't considered the largest institution. If you think about investment banks, you had Goldman Sachs, you had Morgan Stanley, Merrill Lynch. They were all bigger than Lehman, and so they thought, okay, we can let this is a pretty big bank, but it's not too big, we'll let it fail. And look what happened. Mm-hmm. So when you look at a company like Credit Suisse, I would also mention Deutsche Bank because they're always mentioned as another weak company that's very large. They're not going to fail. And so on some level, it's a non sequitur. It's really just about how do they figure out how to manage the risk.
Yeah. Someone asked you, do you think they'll get nationalized?
I mean, it's
complicated in Europe, that question.
Yeah. It's funny you would say that because I was looking at ABN AMRO. I don't know if you remember ABN AMRO, Fortis, and all of that. and the way that I remember it, ABN AMRO still has they still have a bank network. They have a retail branch network. Fortis, basically was nationalized, and then they split things up and so forth. So the thing is yeah, they could nationalize it, but only in the most extreme circumstances. And I don't even know if RBS, Royal Bank of Scotland, if that still is, if the government still owns that in the UK. We're talking 15 years later now.
Yeah. 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 Those are tricky questions in Europe, which is why I think people, and can they move with the speed needed? But you're right about them being too big to fail. That's why they're still alive, right? They've had trouble for the last 10 years and they limp along. But good questions about what might have to happen. What surviving looks like is a very different question than whether you survive. So that's something we're going to have to watch for. Ed, we're out of time, but it has been so much fun to be with you and to have you back on again.
Yeah, it was great, Maggie. Bring me back on again. I'd love to do it.
We certainly will. Anything that you want to leave us with as we sort of, try to navigate through these turbulent times? It sounds like you're really going to be focused on commercial real estate.
Yeah, and I would say that when we look at what happened with SVB, a bank that probably had like 50 billion in deposits 2 or 3 years ago, actually in 2018, they did have 50 billion. Here's a bank that had 200 billion in deposits, not like a super huge bank, and look what's happened to the environment. So this tells you how febrile the environment is, like where we are. So many more things are to come. That's all I can say.
Yeah. And information is power when it comes to that. Ed, thank you so much. And a big thanks to all of the community who's been with us for 3 years. We'll be back tomorrow with an extended Friday extravaganza. It's an hour long. Raul and Andreas are both going to be here live, answering questions, giving us an update and our thoughts on where we stand right now and what we need to look out for. And you'll all get a chance to meet David Madden, who's really concentrating on some of these tech trends. So we're going to put it all together for you. So be sure to join us, share your questions, and hopefully we'll all be smarter for it. So we hope to see you all then. In the meantime, take care and good luck out there.
If we want to change the outcomes for this really screwed up world, where our wages don't go up, where we're being replaced by technology, where governments are massively in debt and we foot the bill via taxes, where we see debasement of assets so we can't afford as many assets as we like, so the rich get richer, the poor get poorer. If we don't like to see the rise of populism based on this broken society because the promises of the future have been broken, let's make our promises to our future selves come right. And that's by unfucking your future. Some of this is going to really fuck your future in 20 or 30 years' time, but we've got time to figure that out because it's unstoppable.